Mayuresh Joshi, Head of Equity Research at William O'Neill, is with us on the show. Mayuresh, lots of fundraise taking place at Nazara and lots of acquisitions.
Afternoon, Rima. Yes, I think the markets are abuzz with a lot of fundraise news that is probably happening at this juncture. But for Nazara Tech in particular, I think they have been on a string of acquisitions in the past few quarters. And therefore, I think how these activities probably play out is something to be probably seen, specifically in terms of this inorganic growth journey. So I think how the execution probably takes place over the next few quarters is something to be watched out for. The second aspect, obviously, is related to the indirect tax notices that the company had received. So to that extent, what really comes out, positive or negative, is going to have some kind of action on the stock itself. Last but not the least, I think the numbers have been pretty steady so far. Balance sheet is relatively strong. Working capital cycle is relatively strong. And therefore, I think these two triggers, one in terms of the acquisitions that they're probably doing, whether they can lay path to a very strong earnings growth in the next few quarters, and two, the execution in terms of their acquisition and the synergies thereof, and how they probably play on the balance sheet is going to be equally.
Mayuresh, anything that you've picked up in IT which explains this kind of nervousness? And is it just like tactical positioning, sector rotation taking place away from IT and banks? And will it continue, this shift away from IT into, say, banks which have underperformed?
I think two things. One, I think the commentary which came through late night last night from Accenture, I think that created a little bit of jitters in terms of the prospects, specifically for this quarter and the rest of this calendar year, in terms of growth dynamics and vectors being played and laid out. Having said that, if you probably look at a lot of management commentaries, Rima, specifically for mid-cap IT companies, vis-a-vis the large-cap IT companies, the mid-cap IT companies' commentaries have been far more robust. A lot of managements have indicated steady state, constant currency and dollar revenue growth. They're also expecting the kind of expenses that have gone up, specifically the outsourcing expenses, to probably normalize in the next few quarters as well. Again, salary hikes will be part and parcel over the next couple of quarters for respective companies. And therefore, I think the EBIT margins will gestate the salary hikes that take place within the system itself. But generally, I think the commentaries are indicating for robust order flows, execution, and therefore margins remaining extremely stable as well. What probably happens in terms of the rate cut cycle, US elections, is also something that is causing a little bit of jitters. Is it the US economy, as some aspects of the market are indicating, is not fully equipped to probably cater to demand, and whether demand is genuinely slowing down in key sectors like BFSI, retail, manufacturing, that might have toll in terms of future order flows. So I think a combination of these factors probably playing out. But our take still remains the same. Mid-cap IT might continue outperforming in terms of numbers compared to large-cap IT. We continue holding stocks like a Persistent and portfolio in our global.
Mayuresh, any thoughts on the upstream oil lanes?
So, Surbi, I think a large part of their variable does depend in terms of how oil pricing is. And therefore, I think if oil prices are on a downward spiral, even if volumes compensate for that, a large element of pricing being not in their favor does not probably get reflected in numbers if oil prices are expected to stay this way. The second aspect, obviously, is in terms of a lot of the exploration needs that will now get fulfilled. Because if you probably look at the oil minister's statements, should be they're expecting a huge amount of capex, both from the ministry end as well as from the PSU enterprises, to probably have a lot of these exploratory wells being starting to begin, both for oil and gas, and therefore taking the entire acreage area from 10% to 16% over the next few years will entail a huge amount of capex. So I think that will also have some element of impact as far as cash flows are concerned. So to that extent, I think earnings might remain a little bit volatile. Even the Singapore GRM prices, should be, as an example, have gone down. I mean, fallen off a cliff. And therefore, I think how OMCs will also report numbers, specifically when it comes to the refining part of the business, is to be seen. The only positive statements that come from the balance sheet for most of these upstream companies is the dividend yield that they probably present. But again, I think on a case-to-case basis, our take is that we remain neutral on this sector, at least at this stage.